As a financial advisor, my clients ask me all kinds of weird and wonderful questions. But last week, a client asked me a great one. He said, James, after the last few years we've had, it's great to see the markets are up so much. But now that we're here and I'm looking to invest more money, it's got me thinking, can this really continue? The thing that's bugging me is that on one hand, the stock market is up 27% over the last year, and yet the global economy is expected to grow just 2.6% this year. Over the last 5 years, the stock market is up 83%, and yet global GDP has grown about 12%. How is this sustainable? How can the stock market keep growing faster than the economy? This is a great question, and the simple answer is that it can't. And based on recent data that I have seen, I have good reason to believe that future stock market returns are likely to be much lower than they have been in the past, but not for the reasons that you might think. So in this video, I'm going to explain what's going on and most importantly, what this means for the way that you should be investing your money and planning for retirement. Over the last 100 years, global stock markets have grown at roughly 10% per year on average, whilst global GDP, which is a measure of the output of the global economy, has grown at just 3% per year. How is this possible? Surely the stock market cannot keep outpacing the economy, otherwise it would just take over the world. Well, there are two ways of explaining this. The first is a very simplified version, for a 5-year-old, if you will. Okay, a pretty smart 5-year-old, but let's give this a go. Suppose we have a company whose share price is $100, and over the course of a year, that company does not grow at all, but makes a profit of 3% of its value each year. It can either choose to pay those profits out to shareholders via a dividend, or it can reinvest them within the business. Either way, as a shareholder, this business has generated $3 of value for you. So that's the first takeaway. A business does not need to grow to create value for shareholders. Now, let's say that over the course of that year, inflation also goes up by 3%. And as a result, this business's revenues, profits, and all else being equal, the value of it also goes up by 3% over the year. So now, as a shareholder, in nominal terms, you've got a 6% increase in value. What we're looking at here is an analogy for an economy with 0% GDP growth. Because what most people miss is that when we talk about GDP growth, it's normally expressed in real terms, as in after accounting for inflation. Let's take the US economy as an example. Over the last 5 years, GDP growth has been up about 10%, but that's in real terms. Inflation in the US over the last 5 years has been about 21%, which means that the US economy has actually grown about 31% over the last 5 years. So if we go back to our analogy, even though the company has not grown in real terms, it's still generated 6% of value for shareholders in nominal terms. But let's say that the company actually grew by an additional 3% per year in line with the growth of the overall economy. We, as shareholders, are now getting 3% of value from profits, 3% from inflation, and 3% from the real growth of the company, which equates to 9.3% of overall value growth for the shareholder. Pretty close to our 10% long-term stock market average. So is this our answer then? If the economy keeps growing at 3% per year, it seems like 10% stock market returns could be sustainable. Well, yes, they probably would be. But the returns that we've seen over the last 15 years have been way higher than can be explained by this. And to understand what's going on, we're going to need to better understand what GDP is actually measuring and its relationship with the stock market. GDP is an attempt to measure the total output of an economy. As you can imagine, trying to add up the value of every car that's been bought, every hour that a lawyer has worked, and every import and export from a country is very hard, which is why not only are there several ways to calculate GDP, but the figures often get revised after the fact. Secondly, GDP is backwards looking. It's telling us what has already happened. And because the numbers keep getting revised, we may only get the final figure 6 months after the fact. And this is what many investors forget. They see newspaper headlines that GDP growth is slowing or that the economy has entered a recession. And they expect that the stock market to be down off the back of this news, only to find that it's often moving in the opposite direction. Take the S&P 500 during the Great Financial Crisis. The stock market started to fall in October 2007, but it wasn't until December of 2008 that the National Bureau of Economics and Research reported that a recession that had actually started. Oh, and by the way, it started a year ago. Whilst it wasn't until September 2010 that they reported that the recession had ended. Oh, and yeah, it ended back in June 2009. So clearly, if you are trying to use data like GDP to time when to get in or out the stock market, you're likely to get it wrong. This point is not actually directly related to the question that we're trying to answer, but it's a really important point that you need to understand. So let's get back on track. As of today, the US markets make up roughly 65% of the accessible global stock market, which means that the US has an outside effect on global stock market returns. So let's take a closer look at the US. Since 2010, the US stock market has compounded at a rate of 13.23% per year, which is significantly higher than long-term averages and is way faster than can be explained by the growth of the US economy. So how is this possible, and is it sustainable? There are three main trends that have enabled this. The first is, if we think about the GDP of the United States, that's measuring the output of the entire US economy by measuring government, consumer, and business spending, investment, alongside imports and exports. Not all businesses are listed on a stock exchange. Many of them are private companies. So only a portion of business economic output is attributable to the stock market. So even if the overall economy did not grow, but listed businesses started to win market share from private businesses, then the stock market could continue to grow even within the confines of a no-growth economy, which is exactly what we've seen with the rise of the Magnificent Seven. Microsoft, Amazon, Apple, Facebook, huge winner-take-all businesses that have dominated smaller private businesses and gained market share. The second trend is that even though since 2010 the US economy has only grown at a compound rate of just over 2% per year, many large US companies have been rapidly expanding abroad into other economies, creating new markets, but also, again, winning market share from smaller local private businesses. This isn't unique to US businesses. Most large listed companies from across the world have been doubling down on international expansion over the last 2 decades. So I hope you can see that even within the confines of a global economy growing at 3% per year, these trends have enabled the stock market to grow at a much faster rate. But these trends cannot continue indefinitely. And certainly since the pandemic, the rise of China, and Trump's incoming tariffs, globalization is becoming harder and harder. The third big trend that has enabled stock markets to grow so quickly is changes to stock market valuations. To explain this, let's go back to our single company analogy. We have a company with a share price of $100, and it's been producing $4 of profits each year, which it pays out as a dividend. Let's assume inflation is 0 and that the company is not expected to grow or change in any way from here. Even at a standstill, this company's share price could still rise. If there is enough demand for it, investors could still bid up its price, perhaps because the other alternative places where they could put their money have become less attractive, or perhaps there's just more demand for risk. So let's say that over the course of 10 years, our company's valuation rises to $150, but it's still only generating $4 of profits per year. Hopefully this demonstrates yet another way that the stock market can grow, even if the economy was at a standstill. But is this sustainable? 10 years ago, it would have cost you $100 to buy a share in a company generating $4 of profits. But today, you have to pay $150. Another word for profits is earnings. So we can use the price-earnings ratio to assess this change. With earnings of $4 and a price of $100, this company has a price-to-earnings ratio of 25. Or, in other words, if earnings continue at this rate, it would take you 25 years to get your money back from your initial $100 investment. But if the price goes up to $150, it would take 37.5 years. The price-to-earnings ratio is a commonly used statistic for referencing how cheap or expensive a company seems to be. And in this example, it's clear to see that you're now having to pay a lot more for those earnings than you did in the past. Of course, if you bought this stock 10 years ago, you're laughing because not only have you been paid dividends each year, but you've also had share price growth of 4.14% per year. But For that to continue over the next 10 years, the share price would need to grow to $225, and the price to earnings ratio would rise to 56. The key point here is that every time the price of the company rises faster than its earnings, our future expected return is getting lower. And it will eventually get to a point where the expected return is so low that it won't be attractive to a rational investor if there are other things that they can do with their money. So clearly, although stock prices can deviate from earnings, and they often do, sometimes for long periods of time, they cannot remain completely detached forever. Over the long term, for stock market growth to be sustainable, company earnings have to grow at a similar rate. The way that I like to think about the relationship between stock prices and earnings is like a child climbing a hill holding a balloon, where the child represents earnings that are gradually growing over time, whilst the balloon represents stock prices that can move around dramatically whenever the winds change, sometimes running ahead of the child and sometimes running behind. But like the balloon, they're always tethered and cannot get too far away. So how does this relate to the real world and what's been happening recently? Here we're looking at the forward price to earnings ratio of the S&P 500 since 1996. And we can see how it has climbed all the way from about 12 back in 2010 to 21.7 where we are today. Not far off from where it was just before the dot-com bubble burst and before the 25% crash that occurred in 2022. Of course, over this period, the companies within the S&P 500 have grown their earnings dramatically. But what this is telling us is that the stock market has grown at a much faster rate than those earnings. So if the market has been getting ahead of itself, what does that mean for future returns? Well, there are two ways that it could come back down to earth. Either via a sudden crash in prices like it did in 2001 and 2022, or it could just sit there, not doing much, whilst we wait for company earnings to catch up with these valuations. But that may mean lower returns for some time into the future, as Goldman Sachs have suggested in a recent report. We estimate the S&P 500 will deliver an annualized nominal total return of 3% during the next 10 years. Although they do provide a range of between -1% to 7% per year, because hey, not even Goldman Sachs can predict the future. And this is a key reason for those concerns. Here we're looking at the S&P 500 forward PE data going back to 1988 and the subsequent annualized returns that have been achieved over the following decade, which demonstrates a clear inverse correlation between starting PE ratios and returns over the following 10 years, in that if the S&P 500 had a low PE ratio at the start of the period, it invariably went on to see higher returns over the next 10 years. Whereas periods that started with a high PE ratio, as we're at today, saw much lower returns. So does this mean that it's time to get out of US stocks? Although there certainly seem to be a lot of good arguments for that case, there are other ways that you could read these tea leaves. Firstly, in the short term, we have no idea when this trend will end. Analysts have been saying that the US markets have been overpriced for years, and yet the stock market has kept trending higher. And although PE ratios may have been a useful indicator of future long-term returns, for short-term returns, they're terrible. This graph is again showing us historical PE ratios for the S&P 500 and the subsequent returns over the following 12 months. And as you can see, there is no obvious pattern. We have been at this level before, and then the market has gone on to grow by 20 or 40% over the next year. So in the short term, I don't think it would be wise to try and time the markets with this information. Then in the long term, even though the evidence doesn't look great, and it's true that PE ratios cannot keep rising indefinitely, some people are arguing that we're now in a new paradigm where it no longer makes sense to compare PE ratios with those of the past, and that higher valuations are here to stay. Maybe that is true, but I think it's a bit premature for us to say for sure that this time is different. We also need to remember that the stock market is forwards looking. It doesn't care what earnings are today. It cares where they're going to be in 5, 10 years' time. So the other way of interpreting these results is that this high PE ratio is signaling that the market thinks that earnings of S&P 500 companies are going to grow rapidly over the next few years, with the majority of that growth coming from the Magnificent Seven. The market already seems to be pricing in a best case scenario, which probably also includes the Fed reducing interest rates rapidly. So if over the next few years, S&P 500 earnings do shoot the lights out and rates fall as expected, then future stock market returns may be okay. Not great, just okay, because that is what the market is already expecting. But if we see anything less than perfection, then the US market could be in for a big upset. Before we can draw any conclusions, let's look at what's been happening outside of the S&P 500. Here we're looking at the current forward PE ratios across different geographic regions and company sizes. US large cap means large US businesses, i.e. the S&P 500. The green bar represents the average PE ratio since 1988. The range represents the 10th and 90th percentiles, and the blue square is where we are today. As we saw before, US large caps are right at the top of this range, but smaller US businesses are actually behind long-term averages. And then if we look across Europe and the UK, we can see that not only are they much lower than the US, but most are also behind their long-term averages. As a reminder, if these earnings remained constant, a PE ratio of 22 would mean it would take you 22 years to earn your money back. Whilst a PE ratio of 12, as the UK is at right now, it would take you just 12 years. I often get asked by clients, why don't I just invest all of my money in the S&P 500? It's performed so much better than everything else, and the US has the culture and resources that make scaling businesses so much easier. Its advantages are clear. To which I say, yeah, they are. But unfortunately, you're not the only genius to have realized this, to the extent that other investors have already bidded up the price of US stocks to the point where they may be getting years or even decades ahead of themselves. How you feel about all of this data is going to depend on how much you trust market prices. There are two different camps that you can sit in. Either you think that the stock market is often irrational, it gets prices wrong, and you think that you can profit from that. Or you think that the stock market is rational most of the time and accurate enough that it's hard to outwit reliably. It's very important that you work out which camp you sit in, because if you sit in the first camp, then yeah, there is a lot of evidence that suggests that the US market is overpriced right now, and you may want to rebalance your portfolio into other areas or other asset classes that are looking more reasonably valued. If you can find one, that is, because right now it's not just US stocks that are elevated. Property, gold, crypto are all at all-time highs. But if you sit in this second camp, as I do, then there are two things that this data should have made clear to you. Firstly, if you're in this camp, then you will know we cannot reliably predict which country or sector is going to outperform in the future. And this data should reinforce why it's so important to remain globally diversified, not just by country, but also across companies that are big and small, which should still leave you with a significant chunk invested in the US. And even though I do really hope that US earnings rapidly grow into these valuations over the next few years, I don't think we can ignore this data. So I think it's prudent to assume that stock market returns moving forward are going to be lower than they have in the past. So if you are doing long-term projections as part of planning for retirement, please do not assume that you're going to get 10% annual returns moving forwards. As an example, when doing linear projections for our clients, we're assuming a 3.81% average annual real return for a 100% stock portfolio. So I think the most important question that you need to answer now is, which of these camps do you sit in? Because I know that a lot of people think they sit in this second camp with me. But when you look at their portfolio, they have all of their money invested in an S&P 500 index fund or a bunch of thematic ETFs, which would suggest that they actually sit in this camp here. And if that is true, then you've got some very important decisions that you need to make moving forwards.